Welcome to the BF Anderson Technical Report for January 31st. Let's get right into the charts here. You can see here we have the NASDAQ Composite, made our low back on the 24th. We're now seeing that lower moving average turning up. This is very constructive, so we're now on a buy signal on the NASDAQ. And this would be true for the other four indexes that we follow. A breakout above 7,200 will look very good. Notice also volume did pick up yesterday after the Federal Reserve did not raise interest rates. We had higher volume to the upside than the prior day, so that would be what we call a follow-through day. Very positive. Now, if we go to the weekly graph, we can still see that on a week-by-week basis, we're seeing some up volume, nothing extraordinary, no heavy buying on a weekly basis. We're still seeing that 35-week moving average somewhat in a downtrend. I would like to see that breakout above that 35-week moving average. Now, if we go to the advanced decline line, we are seeing some improvement there. The advanced decline line is in an uptrend. We're seeing some good advances. Remember, this indicator is one where we take the net advances. So we take the advances minus the declines and get net advances. And yesterday was a very good day. We had net 1,750 advancers. So that is looking promising as well. The high-low index, which is the number of new highs versus new lows, we got down at the end of the year at a ridiculously low level. We've now had pretty much of a blast off. We're not getting really very many lows. As you can see here on the new lows, we only had 13 new lows yesterday, and you can see that over the last, really since the beginning of the year, we have not seen new lows get exceptionally high at all. In fact, there really aren't any new lows. The indexes aren't hitting new lows either. Now, on the long-term indicator, which is the 1020, we're now seeing the S&P 500 get back above that lower moving average, which is very constructive. And you notice here, we're picking up old data, which is causing that upper line to start to turn up. So we're looking better on the long-term trends as well. Now, on the put-call ratio, which measures fear and greed, you can see that we got into extreme fear. We've somewhat normalized. So it looks like to me that the average investor out there or the institutional investor out there is starting to get kind of back to normal. Now, there was a study done by a friend of mine where he went back to the 1950s and he took 21 separate periods where he showed the 100-day versus the 200-day moving average. Now, the bad news is, and this is where we are now, of the 21 cases that he studied going back to the 1950s, a move below where the 100-day crosses a death cross below the 200-day, 80 to 90% of the time, the market would then retest the old lows, and that's 80 to 90% of the time. So it's something we should be aware of. Now, I took a bearish case of that very situation where the 100-day crosses below the 200-day, and you can see here that back in the year 2000, 2001, that cross, it just continued to head down and really bad things happened. This did trigger a significant bear market. Now, if we take the bullish case, which would be 2015, 2016, we got the death cross. However, the index then immediately resumed back above the 200-day. The 200-day never really turned down until we got the retest, but then it didn't lead to a bear market. In fact, it led to a very nice market. So if we go to looking at the blast-off indicator, now this is something that kind of you have to ask the question, is it different this time? Because what happened here with the 2-to-1 blast-off indicator was where we had the New York Stock Exchange advanced declines, where you had advancers beat decliners 2-to-1 over a 10-day period. So you can see here, starting at the end of the year for 18 and in the early part of 19, we got what we call a blast-off indicator. So if we go back and look at the blast-off indicators since 1960, this is a very rare signal. We've only gotten 10 2-to-1 blast off signals since 1960. So maybe it's different this time. So if we go back and look at the last time we got a blast off indicator was in July of 2016, and really good things happened after that. It's just basically signaling that the market is showing extremely rare strength. So the conclusion is, let's keep an eye on the new lows. We are entering earnings season, and then history suggests a possible retest of the December 18 lows, but who knows? We've got to take it a day at a time. Now, the top 5, we're still seeing a lot of technology stocks, mainly software. Here's Alteryx, continues to be in a very strong uptrend. Here's a company called Okta, which is in cybersecurity, hit a new high recently, in a strong uptrend. Here's Twilio, which is a stock we own. Stock continues to act well. This is software having to do with the chat feature on computers. It's a communication network. Here's Workday, which is another software stock, acting really well. Good solid uptrend. We like the stock. We own that stock as well. We also own this stock, Xilinx. Xilinx is a semiconductor manufacturer. They announced earnings. They blew the top off the numbers. The numbers were fantastic. You can see here skyscraper volume came in the day of the announcement. The stock broke out. We continue to like the stock. So in conclusion, what I'm saying is keep an eye on the new lows. We're not really seeing any. There is a possibility that the market's going to retest the lows set back in December. But because of the blast off indicator, also because the trends are starting to turn up, and as well as the fact that the fear greed, the sentiment readings were just so positive, which they were negative, but that means positive. It may be different this time. We may not retest, but history would say we're going to. Well, we'll just have to see. Thank you very much.